Thanks a lot, Ekta. We have with us Geeta Gopinath, Professor Geeta Gopinath. She's the Professor of Economics at Harvard University and a celebrated economist at that. Geeta, thank you very much for finding time for us at a time when you should actually be vacationing. First up, from your vantage point at Harvard and your recent visit to Jackson Hole as well, tell us how the global economy is panning out next year. Will it again, start with forecasts of 3.5% growth and end with a growth less than 3%? Or will the run of weakness end and we'll actually see a better economic growth?
So there are, I think that the world economy is moving to two tracks of growth. There's going to be the advanced economies that have come out of the financial crisis of the last 8 years and are now recovering. And you have the emerging markets, on the other hand, that were previously the drivers of global growth that have, as a block, as an emerging market block, slowed down. I think the exception here is India, which looks more promising than the other so-called BRICS nations. But, we're going to expect to see these two tracks of growth in the near term. After 3 to 4 years, that will reverse. But if you just kind of pause to think about the main global trends that lead into 2016, I'd say there are four, kind of looking at it from the perspective of India. The first is the whole collapse in commodity prices, which I think is a net good for India. The second is the slowdown in growth in China, which has global implications. From the perspective of India's exports, it has smaller negative effects because it's only about 4% of India's exports that go to China. The third is the resumption of Fed tightening, which of course is going to happen at a slow pace, but that has implications for borrowing costs for India internationally. And the fourth is the weakness in advanced economies. Though they are so-called rebounding, there are still weaknesses which should impact demand for Indian exports.
Well, in that case, can you really be that confident of the Indian growth story? I mean, how many basis points higher? Will we grow half a percentage point faster? Do you get to 8% at all?
For India to go faster, I think we should be very clear that the headwinds coming from the rest of the world, while important, are actually of a much smaller magnitude than they are for most other countries in the world. Again, like I mentioned, if you look at the emerging markets group, the collapse in commodity prices, the collapse in China demand is much more problematic for countries like Brazil and Indonesia and Turkey than it is for India. So for India to actually move towards 8% growth, what it needs to do is revive domestic investment. And I think that's the one area where I haven't seen much of a change. If you look at the last 16 months of the Modi government, there have been positive signs. But if you look at corporate investment, private sector investment in India by domestic corporates, that has flatlined. I mean, that peaked in 2011, and that has flatlined. And there are a few factors for that need to be addressed. The first, the promised big reforms, including land acquisition, did not come about. That has to be pushed. The second is you have the problem with the bad assets of banks that have basically led to a collapse in lending. And you have the Indian corporates that are heavily indebted, and that has led to a decline in investment. And the third is, with all the success that the RBI has had with bringing inflation down, but without nominal interest rates having come down commensurately for good reasons, the real borrowing costs are still quite high. So if you want to think of heading towards 8% growth in 2016, you really need to have these three factors addressed.
Well, a part of it was addressed in the mid-year review, but the hint from the chief economic advisor was that we probably have to give up on the fiscal prudence timetable. The stock of debt as a percentage of GDP has gone higher, and the prescription is that it should be pushed even higher. In any case, is that the only way or a good way to push up investment? So indeed, with private investment not taking off, the hope is that public sector investment will step in. But that really cannot be the solution to India's investment problems.
I mean, on the one hand, India has actually had a few fiscal blessings with commodity prices coming down. So, you would think of this as actually a good time where one should consolidate the fiscal deficit. The issues that need to be addressed are structural. There was a period when, right at the peak of the crisis, there was a big fiscal expansion, and that engendered high inflation, that put in high inflation in process. And so we really don't want to return to that, where because of weaknesses coming from the private sector, the government sector steps in, and that generates this excess demand in the economy and inflationary impacts, which I don't see a reason to go that direction at all.
Well, that also brings into conflict the Reserve Bank, given its new responsibilities towards inflation under the monetary policy framework, if indeed fiscal deficit were to rise. In that context, how do you see the Monetary Policy Committee working? Do you see it coming in the first place because it requires an amendment? And secondly, is that a disturbance? How should the markets or the economy prepare for the committee?
So just to get back to your question about the fiscal deficit, I really don't see an argument for moving the target. I think that it's important to stick with the target that's in place. I mean, it's taken a long time for India to build credibility as having fiscal discipline, and that should be maintained. The Monetary Policy Committee is a good idea in the medium to long run. It's the way most policy making gets done in the rest of the world. And so it's useful to move towards that model. Of course, you have to make sure that you have the right mix of people on the committee, and that the right policy making gets done and things are not gridlocked. So, I don't see a need to rush for it at this point, but it's certainly something to move towards in the medium to long run.
Given the policy impulses announced so far and the growth trends that you can see both globally and domestically, what's your own inflation trajectory? Does RBI get to the 5% mark in Jan 2017? Would you pencil in rate cuts in 2016?
So an important factor that has helped with bringing inflation down is commodity prices. And the projections for commodity prices is that they will not rise back up very dramatically, in the next year for sure. So that can help with India attaining its target with inflation. But of course, there are always headwinds that can come about. So we haven't seen much rupee volatility in response to the Fed tightening, but that can change if there is some if there is some concern that the Fed wants to tighten faster, then that can have an effect on the rupee, and through that on inflation. There's a very tight link between those two. But with the policies in place, I think that the best is being done, and so there is reason to be optimistic that inflation will stay on target.
So, I was wondering if you can give us an idea of how many rate cuts one should expect at all under the circumstances.
Yeah, so I was thinking about that myself too. And on the one hand, just in terms of the real cost of borrowing, I mean, if you look at the trend in the real cost of borrowing, it's really quite high at this point. So that would be an argument for cutting interest rates. You obviously look at the inflation expectations. I'm concerned about those measures for India. But if you look at wholesale price inflation in manufacturing, that's barely 1 or 2%, and so with rates at 7%, 7.25%, I mean, these are really high real borrowing costs. So that would give you an argument for cutting rates gradually over the next year. The one headwind that I do worry about is what's happening to the rupee. The rupee still doesn't seem to be on a strengthening trajectory. So with if there is further depreciation of the rupee coming out of international events, then that can have the opposite effect and bring inflation up. I'm sorry. And so, on net, I think that it would be good to see a few more rate cuts.
Okay. Well, finally, from your perch, what does the global financial scene look like next year? In 2015, we had our heart attacks from China in June, first from the stock markets, then a RMB depreciation, albeit small, but when it came, it didn't look like it was the only one. It looked like the first of many. What should global markets, or at least Indian financial markets, prepare for in 2016 from the world?
The Indian financial markets should prepare for turbulence going forward. And the reason I say that is because the global economy while recovering in some areas, is kind of bumping close to the bottom, which means that things can go bad relatively quickly. If you look at the pockets of growth, I mean, the U.S. economy looks like it has, relatively 2%, 2 to 3% growth. But if you look at the euro area, if you look at Japan, they're all relatively weak. If you look at emerging markets, most of the BRICS nations, with the exception of India, look very weak. So we are kind of bouncing at the bottom, which means that there is the possibility of bad news coming out of China. There is a possibility of a euro, a trigger event in euro that questions the existence of the euro area. So I think we are headed for 2016 being a year with, fair amount of uncertainty and turbulence.
All right, Geeta, pleasure speaking with you. Thank you very much for joining us with your perspective on both the global economy, financial markets, and how India might pan out in 2016. Always good to hear from an expert like you. Thanks for joining us.